Hello and welcome to this FE Investments presentation. My name is Greg Colley, I'm the investment strategist here at FEI, and I'll be running you through this economic and market update today based off the back of our latest rebalance. So what's happened since the last rebalance? We're looking across the board, we can see different asset classes and equity markets have all been broadly positive. Now, when we're breaking this down, it hasn't necessarily been a case of a change in investor sentiment prompting particularly good performance, but it's more been doing, it's more been an unwinding of negative performance in the previous period. Looking at the top two performers there, Europe number one and the UK number two. This certainly holds true for these two regions. So for the UK, for example, this performance period we're looking at starts in the middle of October. And this was really the height of the mini budget concerns when we had not just a sell-off in government bonds, but also the equity markets as well. Similarly, although of course not to the same extent, the European market was down throughout last year due to Putin's brutal invasion of Ukraine. As time's passed and the concerns and fears for escalation have started to alleviate somewhat, the equity market in Europe has started to improve, as well as the conditions starting to suit it a little bit more as well. So that really explains some of the better performance in those regions. However, when we just zoom out, we get a better idea for the performance over the last year or so, and helps to kind of picture that 6-month period, because we can see on this 1-year chart that at the middle of October, we are really in that sort of trough in the cycle there. Now, one reason for this is the inflation sensitivity that there's been in markets across the last year. We really start to see that downturn from August onwards, which is when Putin started to weaponize gas. And then similarly before that, that's when we saw a dip in prices when we had the oil prices starting to rise. But then as those fears started to alleviate, when the concerns, again, weren't so great with regards to oil, markets started to improve a little bit. So we can really see just how sensitive markets have been to inflation. And that certainly held true so far this year as well. Here we're looking at year-to-date performance. So again, over the 3 or 4 months that we've had so far this year, there's been 3 dominant themes that have really driven the markets. And it's all been largely due to inflation expectations. Through January, there was the general investor sentiment that we'd see a soft landing. And as a result, equity markets performed quite well. Bonds were also positive, though not quite as positive as equities. This very much changed in February when we had the surprise increase in inflation in the UK, which led markets to believe that inflation was going to be higher for longer. And as a result, government bonds sold off, whilst equity markets, depending on the sort of stylistic approach, sort of either increased or fell in value. So the FTSE All-Share, for example, due to the value bias, improves in value because it benefits from a higher inflation environment. Whereas across the world index was slightly down over the period. Through March, we again saw this sentiment change as fears of a recession started to mount. This was largely prompted by the bank failures. We saw equity markets sell off quite heavily whilst gilts increased in value. And that's really what we want them in a portfolio to do, to provide capital protection in these uncertain times. But ultimately what this volatile, chopping and changing kind of environment shows is that these inflection points and trying to identify where exactly we are in a business cycle, it's very hard to do. Because what we know over a 12-month period is that we'll probably see growth turn negative, we'll probably see inflation fall, and we'll probably see interest rates come down as well. The tricky parts lie in identifying what sequence this is going to happen in, and at exactly what point this will happen as well. So this is really important when it comes to creating portfolios to make sure we're not overexposed to any of these potential risks. So the short term is quite hard to predict what's going to happen, but over the long term, we have a better idea over the expectations within the market. Inflation, for example, in the US expected to fall back down to 2 to 2.5% or so through 2024, which means on a 24 to 36 month period, things are looking quite rosy. If we see inflation fall back to target, that's going to obviously be good news for bonds and fixed incomes because interest rates will then come down with it. But this also may signal more normalization in the wider economy. We may see growth return back to trend, and that will also prompt some more positive equity performance as well. So from here, bonds are looking quite cheap, and equities probably more average, given that there could be some volatility as economic growth starts to slow down. Now, the inflation picture in the UK is very different to what we're seeing in the US. At the moment, the US, their headline CPI is sitting at 5%, whereas in the UK, we're still in double-digit figures. So yes, we saw it decrease from the previous month, but it's still very much problematic. Now, the UK has UK-specific factors at play, and this is where we're really starting to see divergence across compared to US and Europe, for example. Not only are our core services and core goods proving very sticky, you can see by the chart on the right-hand side, they haven't really dropped a great deal or moved a great deal for a number of months in a row now. But we've also got a bit more of a problem with our food inflation. We import lots of our food from European countries, and some of them have been facing poor weather conditions recently, such as Spain, which has affected the amount of food and crops they're able to produce. But this means, due to Brexit, really, we're pretty much bottom of the pecking order in terms of who gets that reduced allocation. So if we can't get it from Spain, we may have to look further afield, and ultimately, due to higher energy costs, probably have to pay more for the food to get transported across Europe, as well as then having to pay more import and export costs as well, which is ultimately driving some of this higher food inflation. So the UK compared to EU countries, for example, this is much more of a problem focused on the UK. So that covers inflation, but in terms of this slowdown in growth and recession that's being talked about, well, when is this going to happen? At the moment, we're seeing real-time data remain fairly positive. If you're looking at employment or payroll data, for example, things aren't looking so bad. It's really when we start digging up the leading indicators where things are a bit more negative. So things such as credit impulse, for example, is not predicting the future is so great within the financial markets. But just focusing in on the employment and payroll data, for example, we've got the NFIB data here, which is looking at the left-hand side, whether or not small businesses think it's a good time to expand. And then on the right-hand side, whether or not businesses are positive or negative about their hiring plans. As we can see, the navy blue lines on both charts have been falling for a while and remain fairly negative, which indicates in 3 to 6 months' time or so, these businesses are probably expecting a downturn in business activity, and therefore they're not willing to spend more on their businesses, whether that's through expansion or through increasing the number of employees. Ultimately, to see a recession, we have to see this data come into fruition, because as the unemployment rate increases, that means less people are going to be earning money and spending money in the economy. So the overall level of money circulating in the economy is reduced. So once we see this data feed through into the real-time data, we can probably expect to see a recession. So at the moment, given there is sort of a 5 to 6 month outlook on this, the market consensus is that we'll see a slowdown in growth and potentially a recession in the second half of the year. So in terms of the portfolios, currently they're positioned for inflation, and this has really been the positioning since August, where we started to cut some of the allocation to government bonds. As we can see from the chart, that proves to be a good decision. We had the mini budget concerns pretty soon after that. Of course, we couldn't predict that, but at the time we had oil prices pushing up quite high. So it was potentially going to be a scenario of stickier inflation in the future. And then also at the start of the year, we started to get a bit more concerned about a surprise upside to inflation through the early months. And this, one, came from inconclusive data, but China's reopening really played a role in this as well. As their economy reopened, that meant for the Chinese consumers themselves, they could be driving global growth to some degree, and luxury goods have really seen the impacts of that. They've had a really strong couple of months thanks to China's reopening. But then also the manufacturers and producers pushing their factories back to full-scale operations, that's going to use a lot more energy than they initially were as well. So as a result, that could have spiked up inflation in the early months of the year, which is what we did see. So the positioning has been accurate so far this year. And what it means is that we're protected from the falls in value more so, but ultimately if we see a strong recovery or good performance in the markets, we may not quite capture all the upside that some higher risk investments could. So as we move through the year and progress, we're starting to prepare for a recession a little bit more so. And one way we're doing this is adding bonds back into the portfolio. So we sold bonds at quite a good stage just prior to the Trustonomic period. And why we think bonds are a good, why I think it's a good time to begin adding bonds back into the portfolio is because although we don't know when a fall in inflation or a recession may start, bonds really should provide some form of recovery in both instances. So if inflation falls, investors may start to price in the prospects of either a pause in the rate hike cycle or they start pricing in rate cuts, which will mean bonds will increase in values. Or if a recession starts, we should see a recovery in bond values as well, as investors will de-risk and move into safer assets. And we saw that in the first chart, or the third chart even, when we looked at the banking failures, when equity sold off, bonds increased in value. Ultimately, the timing is very difficult to get right. As I said, we don't know exactly when this is going to happen, and we could be a bit early to this. But ultimately, the risk of being late is far greater than the risk of being early because we've already seen the types of increase in values we could have in the bond space, and that's not something we want to miss. So the outlook for the rest of 2023. As we said, we know roughly what's going to happen, so there's three main scenarios to prepare for. It's really a case of the sequencing risk and the timing risk. But number one is the possibility for a bigger recession to show up than expected in the second half of the year, and that will lead to a faster fall in inflation than expected. And this will lead to a larger equity sell-off, whilst bonds will do well. Number two, inflation and growth persisting for a bit longer, and then falling a bit before stalling. Central banks would have to revise up their rate hikes, and this wouldn't necessarily be great for anything, but in this instance, equities would probably be a bit more stable than bonds, so we would prefer them in this instance. Number three is the soft landing case, inflation falling but growth persisting, and that would be good news for everyone, but it doesn't seem too likely at this stage. So at the moment, the portfolio is a position for scenario two. We're able to have a good allocation to value investments to pick up in a stickier inflation environment. We do have the portfolio rebalanced and prepared for scenario one, so we're ready to go when we start to see that trend develop. That concludes the presentation. Thank you very much for listening. If you do have any questions, please get in touch with your advisor. Thank you.